Good morning, everyone, and thank you very much for joining me. This is the morning market review, and it is Wednesday, the 20th of September. My name is Russell Shaw. I'm a senior market specialist at FXCM, and my email address is rshaw@fxcm.com. And just going to go ahead, bring up our disclaimers. Start with the high risk investment warning. Good morning, Raj. Nice to have you on the webinar. James, Kim, pleasure to have you on as always. Thank you for joining. Thank you everyone for signing in this morning, much appreciated. Just going to go bring our market commentaries disclaimer up. Okay, and MarketScope 2.0 and TradingView.com are our references. Just having a very quick look at TradingView, looking at the real yield, the benchmark yield, the 10-year. We've got the green exponential moving average above the 10 exponential moving average. It's moving in that northeast direction, and you can see that the RSI is above 50. Okay, so by and large, the real interest rate looking positive. Why is that important? Well, today we're going to have the FOMC meeting, right? The statement coming out of the Fed. It's going to be at 8 p.m. ZA, which is 7 p.m. UK. We're going to stay at the top of the range at 5.5%, and we'll have the press conference a half hour later. So we'll see how this chart and the 2-year change over the next course of the next 24 hours or so. With the movement up, we've tend to look at that as being dollar supportive. Tend to look at that as being dollar supportive. All right, let's bring up the let's bring up MarketScope here. I did say yesterday that we're going to run through the settings because I felt I did them a bit rushed yesterday. So I'll just start off with the weekly. Just adding on to the weekly, I just add, sometimes I take it out, a 30-week exponential moving average. And then the RSI that I tend to use is a number of periods 10. It's calculated not off the close, okay? So most RSIs would be calculated off the close. I like to calculate it off the median, which is the high plus the low divided by 2. And I use 80 and 20 as the overbought and oversold. Okay, so you can see that dollar above the 30-week moving up, and the RSI above 50. This we drew in to show that the bulls ended last week in control, and we want to see what that means for the dollar this week. And then, given the fact that we're in uptrend, higher trough, higher peak, we go down to the daily chart, and we just want to synchronize that up with the daily chart. And you can see we use zones here. These zones are derived from Bollinger Bands. The red Bollinger Band is the 20 period with 2 standard deviations, and then I take the actual average out. Okay, so the it's calculated off a simple moving average, and that's been hidden. Hard average line, yes. That's the red. The blue is 20 and 0.75. Okay. Now, again, we've got the higher trough, higher peak. We're in zone 1. Okay, so dollar looking pretty strong at the moment. And then, of course, the RSI just moving along nicely between 50 and 80, calculated off the median, and it's at 10. Going down to the hourly chart. Right, you can see right away that the R1 is acting as current resistance. So what we got here, let's just start off. I add in the pivots here. These are classic pivots that I'd use. The moving average, the green moving average is a 5-period exponential moving average. So I'll just wait for the I'm just waiting for the let's go to trading view. All right, so if I'm on the hourly, okay, the green moving average is the 5-period exponential moving average. I make that green, and the orange is a 10-period exponential moving average. Okay, so that's typically what we are looking at. All right, we've gone back to market scope. Just one more indicator to show you guys. That's the stochastic. So the stochastic is a 1555. Okay, 1555, and that's the indicators. All right, so I just wanted to run through those because I have had a few requests. Don't candles want to return back to the moving average? Let me ponder that. The moving average is it's derived from the candles. Okay, it's derived from the candles. What tends to happen is that depending on what period your moving average is, you're going to be either quite close or quite far from the candlestick. If you are using let's say a 2-period, you're going to be hugging the candlestick. If you're using say a 50-period, it will be more delayed. It will be away from the candlestick. It can be used as an overbought, oversold indicator. So if it gets too far away from the moving average, that would probably be registered as overbought. If it's too far to the upside, and if it's too far to the downside, it will be regarded as oversold. But it really is a function of the period that you're using. You can see here we're using here a 5 and a 10, and you can see that the 5 and the 10 are very close to the candlesticks. Over here I'm using a 20, 50, and 200 exponential moving average, and you can see that instead of using just a single moving average, I'm using the 3 moving averages to get a feeling of the trend. And I'm looking at what I want to see with the moving averages is angle and separation. Moving in that northeast, that would suggest quite a large momentum. But at some point, if it gets too far away, say from the 200, like we did over here, okay, it tends to snap back. Okay, so it can be used as an overbought or an oversold. It's not my favorite overbought or oversold. The moving average is not classified as an oscillator. It's generally the oscillators that would be overbought, oversold. There's a specific category for moving averages. And what's the category? Trend following indicators. Trend following indicators. There's a few different indicators that are categorized as trend following. One of those would be moving average. Another one would be the, I think it's called the DMI. You know, so the idea here is moving averages, if you are in a consolidation, are going to give you whipsaws because they're not designed to be used in consolidation. But if you've got a trend, as you can see with the dollar here, you actually get quite a good indication when you've got the green above the orange and the orange above the red. You can use the moving averages to derive what's called the price oscillator. That would give you an overbought, oversold. I have used it in the past, not recently. So the answer to your question, Kim, is yes, you can get a sense of overbought, oversold, but that's diverging from the category. What's the category? Trend following indicators. If you want to use an overbought and an oversold, you don't really have to go far past the RSI. I think the RSI gives wonderful overbought, oversold readings. So we can actually take a look here at, say, oil, because oil is currently overbought, right? And we can see what's happening with the, so here is quite a big gap. Okay, so relatively overbought. But let's use an RSI. Let's use an RSI. The problem with the price oscillator, which is derived from the moving average, is that it doesn't have upper and lower limits. So you've got to be, it's quite subjective in terms of what's the overbought, what's the oversold. You can overlay it with a Bollinger Band to get like a dynamic overbought, oversold region. But the moving average is generally trend following, derived from price. So it's going to follow price up or follow price down in the trend. I hope that answers your question, Kim. Let's just go back to, all right, let's go back to US dollar. All right, let's go through to the hourly chart here. All right, we can see that there is a bullish crossover on the dollar. We can see that it is in the upper quintile. So it does look as if there is support for the US dollar as we start out at the trading day. Let's have a quick look at the euro just to see if that's matched with opposite signals. All right, let's move this here. Okay, and you've got the crossover there. So this is where the impulse seems to be. What we would need to see, if there is a pickup in the US dollar, we'd need to see angle and separation to the downside with the euro. And of course, we would want to come back to the lower quintile. Okay. Let's take a look at cable. Now, something interesting happened with cable is that the inflation numbers came in softer than expected. Interestingly, the cable pairing has reacted to the downside. Okay, so here's trigger 1, here's trigger 2. and then we just want to see if it hangs out in the lower quintile. If it hangs out in the lower quintile, and we get angle and separation on those EMAs, then potentially some sort of softness coming in. It's all stemming from US dollar here. We want to see if the US dollar gets some sort of bid. Okay, so the spike up here is probably a result of the inflation numbers that came out of the UK. I just want to take a look at gold and DAX, and then we'll end off and we'll do the crypto minute. So let's go through to gold. All right, so gold's been fairly resilient. It's trying to break into zone 1, but it actually failed. I think there is going to be a resistance here. The reason I think there's going to be a resistance is because I think the Federal Open Market Committee holds the range between 525, 550, but I think it's a hawkish hold. I think they're going to come out and say inflation's too high and really talk holding rates up higher for longer. And we're also going to get the dot plot, so we'll see if the dot plot shows another rate hike, another rate hike. So the idea here is that we are going to probably get some sort of resistance here. It's already fallen from zone 1 back into zone 2. James just asking for the moving averages. They are 20, 50, and 200 exponential moving average. So green's the 20, orange the 50, red's the 200, and the exponential moving averages. I prefer the EMAs over the SMAs for the triple moving average system. All right, let's just take a quick look, see what's happening with the DAX. All right, DAX to me really just been moving sideways since April, hasn't it? No volatility. It's really just quite a pity that we're not getting the volatility out of the DAX. It's hugging the 50, and we have slipped into zone 3. Okay, we slipped into zone 3. So perhaps a slight downwards bias here. So like R1 would be, I think, a reaction level to watch. And if we get the triggers to the downside, we'll need to get a trigger to the downside here on the stochastic as well. I think we could get some 1, 2, and 2, 3, okay, or maybe even 2, 3. But I think once we get that potential impulse coming in, so we just want to keep an eye on that. All right, I'm going to leave it there because the we're already 1 minute after the hour, and we've got to start the crypto minute. So I won't take any questions. What I'm going to do is wrap up here, and we will meet again tomorrow morning. All right. If there's any questions, just go ahead and email me. Thanks very much, guys. Have a great day ahead.